Hey, what is going on, everyone? Welcome. Just waiting for Christopher to join us, and then we will get started. There are a couple of things I wanted to talk about first, as soon as some people join. One second, guys. We're going to get started soon. All right, so I think I'm just going to get started first, since there's quite a few things I wanted to talk about. That being, I don't want to get too much into the markets yet because I'm sure Kris has a lot to talk about regarding that. What I do want to talk about is some earnings. We had a lot of earnings that came out, especially with Adtech, mega cap, of course, Google. I know Google is a big news. That's something we're going to talk about today as well. But for me, you guys already know I focus a lot on the micro. A lot of companies other than mega cap. That includes a lot of ad tech companies, TTD, Reddit, AppLovin, and so on, a bunch of other names. And what I also want to get into were some software names as well. We had a Cloudflare report today, which was an amazing earnings. We had a few other names report recently, ServiceNow, and so on. And I kind of wanted to touch on that a little bit. Probably better time to do this now before Kris gets here, so that way we can start talking about Google and all the market updates and everything, and then start giving both of our inputs. Yes, good evening, everyone. How are you? How are you? How are you? How are you? Yes. All right. So let's just go down a list here. If you guys have any specific questions of any stocks you want to look at, here we are. What is going on, my man?
I joined the Cash Flow Chronicles. What is that thing called? Link that I had from Matt. So I was like,
Oh, there you go.
huh? I'm on the thing, and I was like, oh, wait
Yeah.
a second. No, this doesn't make sense. Yeah.
Okay, cool. That's good. Glad to have you here. Yeah, I was gonna go over the software and ad tech stuff. But yeah, I mean, since you're here, we can just go ahead and get started.
Yeah. Do it.
I mean, it's been some time. I've been on vacation, but now I'm back. I was still active on social media, trying to do as much as I can in the Discord, but here we are again. So we're going to continue our weekly cadence. Our plan is to have the weekly Patreon exclusives like we always do, and then supplement that with public episodes if we do, because we need to prioritize, of course, you guys who are here in our community. But also, what we're thinking about doing, and we haven't decided yet, is to release these Patreon exclusive episodes at a later time after we record our videos, and do any edits if we talk about certain things that we don't want the public to hear about, and so on. But for the most part, I would think after a week, a lot of the information that we talk about is likely stale. I would even say that even after 24 hours, it's stale according to today's markets. Like if you literally talk about something today, Trump could tweet something tomorrow, and like everything could change, right? So we're going to give a little bit of ample time. Haven't decided yet though, but this will of course remain available to you guys as recording since it's on YouTube, but it is unlisted. So no one can search for this episode. Even if you subscribe to our channel, Hidden Edge Podcast, you can't find the episode. You need the link to access it. So please do not distribute this link to anyone other than people inside the Patreon or inside the Discord as well. So let's go ahead and get started on. I mean, the last time we had an episode was basically Liberation Day. It was by far the most
Obliteration
painful.
Day.
Yeah, Obliteration Day. It was the most painful weeks I have probably ever had in this size of portfolio in my entire life. I mean, I've been through COVID. I've been through 2018 and 2022, but just that wasn't like a big deal as much as this one is, because I'm like so mentally invested in this, and just going through that, it
Definitely
was
not
not
fun.
fun,
Definitely
man.
not fun.
I went from like 22% up year to date in February down to like 20% down. And I'm like in Europe, and I'm like, oh, well, this is just a massacre, right? It's just decimated. But good to see that everything's all good. Well, I don't want to say it's all good and dandy now, but
It's recovering. It's
it's
recovering. So
recovering.
there's still areas
Yeah.
of the market that, we have to be very cautious of.
They haven't
I don't
recovered. Yeah.
Yeah, no, there's plenty of areas. The only thing we'd have to okay, so let's go over some of the main changes that happened after Liberation Day. One of the things is that you're starting to see the administration soften their tone, which is good, because as they soften their tone, that means that they're understanding that what they've done is basically going to cause all sorts of problems. I think today's trade deal, even though in my opinion was probably a nothing burger, really, because I mean, we had a trade
Yeah.
surplus with them. They pretty much kept on that 10% tariff anyway. I mean, they tried to make it a symbolic victory, and it was a very interesting thing, but it was not even remotely the thing that's going to get us over the hump. Now, this did provide like a framework of what the administration is looking for. And I think at a baseline, a 10% tariff on every single country is pretty much a given at this point. I don't even think that's a negotiable thing, So every single country is going to be paying 10% to access the US markets. Now, there's a reason for that. One, it's a revenue generator, right? It brings in revenue. Now, the challenge with that is that some of those costs are going to be borne by the producers. Some of them are going to be borne by the exporter, the importer, but eventually everyone passes along the cost to the consumer. That's just how it works. Now, the key is, in terms of inflation, it's a one-time rise in prices, right? So if something costs $100 and you put a 10% tariff on it, it's going to cost 110, but the year after that, it's still only going to cost 110. So it's not like tariffs can compound on themselves. Now, there is a challenge that if people get too addicted and countries get too addicted to tariffs, they'll become like, hey, listen, instead of trying to actually be fiscally disciplined with ourselves, let's just raise the tariff to 12%, and then let's just raise the tariff to 14%. And that's where you get like Banana Republic status, and you just start, doing really dumb things economically. So I don't think we're headed in that direction. I think this is a one-time thing, but the bond market absolutely hates this. Okay. They are in long-term bonds are actually rose today. So you would think that with a trade deal, people would have been like, oh, thank God. Like there's no need to worry. The bonds can kind of come down, and bonds didn't come down. The long end of the curve, pretty much all the treasuries, they ended up curving higher, which is not good for TLT. Now, I personally think that TLT, this is the perfect time to buy it, because the entire market is kind of like turning against it. So a lot of the market is basically saying, well, inflation is going to be higher for longer. And all the data that I'm looking at is actually pointing towards a recession. And as a recession comes, recessions are highly, highly disinflationary. So I think the way that I'm positioning myself, and the thing that I've been describing to you guys, is we've already got the go ahead from the president, from Scott Bessent, from a lot of people, that the Fed needs to start cutting interest rates. Now, the Fed is not going to consider cutting rates until they can get a definitive answer on a weakening economy and an inflation rate that's actually coming down. Now, in my opinion, when I look at the inflation rate, it's already coming down. Core PCE could stay a little bit elevated, but if you look at CPI is down, oil prices are down. I'm seeing shelter, like increases in inventory in certain parts of the country, that's going to probably cause some challenges here and there. So I think overall we're in a place where shelter is coming down, oil is coming down, a lot of the inputs are coming down, and the consumer is scared. The consumers are not going to go out there and spend like crazy if they think that the economy is weakening. So all the survey data is also pointing towards a consumer that's likely to cut back on some spending. You can already even see that with McDonald's and some of the other retailers, where basically they had flat to negative year-over-year growth in same store customer sales. So when you combine all of those things together, you can kind of see that the consumer is actually taking a step back as well. I think we could be already in a recession. And if we are in a recession, I think the Fed is going to be forced to cut. Now the thing is, if we wait for the hard data to come out, we're not going to get the deal on TLT. Like TLT will climb up to the 90s again, and I mean, you'll get a deal, but it won't be the deals that we're getting right now. So the two strategies that I used is I did the $95 call and I sold the $100 calls against it for January of 2026. The reason why I did it short term is because if there is any deals or anything like that gets announced that are more broad, and you see like some policy actions by the Fed, you're going to see those yields come up rather quickly. Now, my goal is hopefully not to hold this thing all the way until January. If I can get a 200-300% return on that position, I'm going to take it, and I'm going to basically utilize it to dump it into 2027, because I think majority of the disinflation and deflation is actually going to be happening in 2027. So I think this year we're likely to get about 3 to 4 rate cuts. We could get like a major rate cut if the economy really weakens and we see a bottom forming with the stock. So one of the things is, I don't know about you guys, but I think the run that we're seeing in stocks right now, people are getting a little bit greedy, getting a little bit complacent. And a lot of the earnings that we saw were from front loading because of tariffs. So it's going to be a really hard thing to do going forward, so is TLT for a trade? Is it possible to buy just the stock or strictly options? You can buy the stock, you'll get a monthly return, but it's not going to be significant. Like, it's literally going to be like 4.5% per year. So on a monthly basis, you'll get a return from it. I'm doing an option strategy as a way to cover against a recession. So I'm predicting that we actually have a really good chance of getting into a recession. So what I did was I allocated 10% of my portfolio to hedging, because I want to make sure that, hey, listen, if the recession does come and something happens, this thing can 5x on it and cover any of the other positions that I have in terms of like going down. So right now, if you look at the markets, the markets, they took a beating and things went down. So I'm underwater on things like Google right now. I'm underwater a little bit on not really much. Actually, Carnival already came back. Norwegian's already starting to come back. Grab position is good. Nubank is good. I have a little bit of exposure to Venture Global.
You got Carnival at a really good price. And
yeah, $2. Yeah.
There was a minute when that came back because Carnival went as low as $17. I think when it was around there because of the depreciation of the premium, I think people could have strategically gotten in where we got in originally with Carnival and then gotten the appreciation from that in a very short period of time. Carnival's at like $21 right now, which is great. So also the good thing is that those options expire at the end of 2027. No, end of 2026, right?
Yeah.
End of 26. You got about a year and a half before that expires, which is still an ample amount of time to outpace whatever short, whatever slowdown there might be in the economy. Hold on, let me actually.
Now, one of the things that I might actually do, if things run really, really hard and we get overbought, I might end up just being a little bit more prudent and basically roll the position down a little bit. Now that's what I did with Carnival originally. So what I would do is basically buy back downshifting. I would buy back the $35 call and then move it down and sell the $30 call. So now I'm collecting that premium. So I'm capping my return to $30, but I'm also securing this additional cash that I can use to deploy if things really get hairy again and I can deploy it again. So the point is right now, be a little bit defensive with the portfolio, and the way that I'm doing it is, of course, through two different leap options. One is through $95 calls and $100 calls against it for 2026 January, and the other one is January of 2027, 95 and 100 105, and the another one is I have some that are $100 calls and $110 calls against it. The reason for that is, to me, it's very simple. Economy weakens. The Fed's job is cut interest rates. They need to cut the long bond, so they're going to literally dump into the long bond. And if they dump into the long bond, TLT should rise. On average, if you look at TLT should be closer to like 3% if inflation ends up getting back down to the 2s, which I think it's already happening. So if the 10-year is around 3, you can safely assume that the 30-year is going to be closer to like maybe between 3.5 and 4. And if we're there, then it'll be at $100, the TLT position. But like I said, the Fed right now is in a really tough bind because they don't know what's going on with the tariffs and if that's actually going to show up. And the bet that I'm making is that, yeah, eventually the numbers will reflect a weakening economy. And if that happens, the Fed is going to be forced to start cutting. And I think a lot of people are going to front run it and start dumping short-term treasuries and going into long treasuries. And especially if the stock market is higher, they're not going to say, yeah, let me buy more, equities. They're going to say, yeah, I'm going to jump into the safety trade, which is the US Treasury. The other thing is with regards to balancing the budget, with all of the revenue that's coming in from what is this thing called? From the tariffs, that can be used to kind of balance the budget a little bit. And so that's helping control some of the additional fiscal what is that thing called? Fiscal revenue portions of it. And the Trump administration is still cutting heavily into spending. If you look at the year-over-year spending that the Trump administration is doing, it's only like $100 billion more than what they spent last year. So I think he just released it right now. I think you saw this, something called the skinny budget. So there's a lot of cuts that are going to be happening. So a lot of that is going to show up probably by the end of this year. So, yeah.
So I wanted to provide my input on the TLT position in terms of long-term rates. There are a few things I want to point out here. I'm going to bring up the trading view. All right, here we go. So this is the 10-year, right? And it's actually doing pretty good overnight right now because it's actually the yields are dropping, which means the bonds are going up. We saw this dramatic move over here on Liberation Day when we saw the yields for the 10-year go from like 3.8% all the way into Liberation Day, all the way up to April 9 when it went April 11 when the tariffs went into effect that evening, and bonds just dropped like a rock, and the 10-year went all the way up to 4.59%. That was an insane move. That's a very big move for a bond market. There's a lot of money. The bond market is a $22 trillion market. Okay. It's pretty much one of the largest markets in the entire world. To make a move like that is extreme. Some people were moving some serious money. And when you talk about the bond market is not a host of having crazy moves like this. They usually have very slow, methodical moves. But if you look at the history of this chart, ever since Trump was voted president, these are very dramatic moves to be occurring in the bond market in a very short period of time, right? Like, see, bond markets generally trend up in a direction for a long period of time and trend in the other direction for a long period of time. Like, this is insane, right? So I do expect this long-term downward trend to continue. I'm targeting around 3.2%, 3.5% in the 10-year rate, which would put short-term 2-year probably around 2.7, 2.8%, which is the Fed's target for their rates by the end of 2026 or 2027, I guess would be the SAP that would be coming up. And since the 2-year treasury is the terminal rate of where they think the rate will be in 2 years at maturity, That is what the market is generally targeting, where that 2 years. Right now, the 2-year is at 3.87%. In my opinion, I don't think that I think that's too high. I think rates will be a lot lower in 2 years versus 3.87%. So therefore, I'm expecting a 100 basis point downtick in the 2-year, but we're not playing the 2-year. We're playing TLT, which is the 20-year and the 30-year bonds, mostly the 20-year bonds, right? So the 20-year is currently trading at near 5% right now. So if I look at the 20-year chart over here, it basically made the same big move as well. It was over 5%, similar to the 30-year is also over 5% as well. Ironically, the 20-year was actually inverted to the 30-year for a minute, which was a very crazy thing to happen in the bond market, especially at that long end of the curve. But anyways, the 20-year should roughly land itself around 3.5%, which would bring TLT probably to like $100, right? So if TLT gets to $100, that means that currently the options that I have are the 2026 9,500 calls. I recently took profits on my TLT naked calls. I took profit around $90. It looked to me like it was going to be a pivot point, and luckily it was. And I bought back into the TLT spreads that Kris has for the 2026 9,500. And I mean, really, I think I'm just break even on it. I got in around 87, so that's pretty much where I'm at right now. Got a little bit of time on it, but because of the fact that they're so far out of the money, we're going to need a big move. And the reason why I think that big move is going to happen is because I agree with Kris. I think the economy is going to continue slowing down. I personally think next quarter is probably going to be another contraction, and I think we are already in a recession. With that being said, there's a likelihood that we're not going to be in a recession. And then the more we get the news that the economy is doing just fine, last Friday, we had the jobs data come in from ADP payrolls a lot better than the market expected. The market expected 133,000 jobs. We actually ended up getting 177,000 jobs, and the market rallied off of that one. Also, unemployment stuck around 4.2%. Also, on top of that, inflation came in line. So the market's like, hey, I guess we're all fine right now, right? We don't need as many cuts or whatever. The 10-year ended up going back down to around where it is right now. Actually, the 10-year came down actually, but then after the commentary of Powell, it basically made its way back over here to 87. We jumped up about 10 basis points the last couple of days. These are just minuscule moves in the 10-year. But these are not dramatic moves. These are normal moves. So I wouldn't really freak out or anything about a 1% move in TLT. With that being said, if the market has a breaking point, right? We saw toward the end of 2024, TLT make a huge move all the way from 100 down to about 88. And it was the market just kept going up. It didn't care about that, right? And then we saw it come back up. We saw it come back down here. And it was like around here, December, when the market was like, wait a minute, hold on a second. The rates are going a lot higher, right? Like there's always a breaking point with the market, and it's a moving target, but there's always a certain point as the yields rise where the market's like, hold on a second. This is pretty bad. Is this going to get worse? We're going to freak out, right? And I don't think the yields are going to get to that point again, because we saw what happened when yields got to 4.6% in the 10-year. We had the Trump pivot. That's when they stepped in and they pushed the 90-day, they pushed the tariffs back, besides China, 90 days. And that's when the entire story changed. And that's why I think we might have seen the lows already in this period, probably for the year, in my opinion. And I do think we're in a recession, but I don't know if that means we're going to revisit the lows. We don't have to be in a massive bear market during a recession, especially during a mild recession, which is what I expect to happen if we do get into one. Like, we are so prepared for a recession. It's not even funny. Like, the Fed is so ready to do something, and he stipulated that in the commentary from the presser multiple times. And Trump will if we're in a recession, Trump will back off. He's not going to continue letting the economy become a recession, because we are so close to those midterm elections. And if we get into a deep recession, it's going to last throughout his presidency, and people are going to think he was the worst president in the entire world. He doesn't want that. And Scott Pissett doesn't want his Wall Street buddies to lose either. All right, let's be honest. Like Scott Pissett is Wall Street. Okay, he doesn't want to get that way. Whatever. So the risk reward in TLT, in my opinion, is pretty good over here. But mind your risk, right? This is not like a position where you want to go all in. Like with any position that I have, I never make it more than 5% of my portfolio. And if it's in options, it's probably less. Like you guys have to have a cap with that. You have to know what your risk parameters are, and then figure out how much you're willing to lose. Because technically speaking, anything you put on, you could lose, right? Unless you go all in like S&P 500, you're not gonna lose your money. And if you do, then you got bigger problems to worry about. But when it comes to options, you can lose all your money, right? You can lose every single penny, and then you can average down whatever, you lose more money. Like you can. This is not something that you want to play around with unless you know what you're doing. And that's the reason why we always advise risk management, because that is the most important thing in this entire game. So anyways, that being said, 2AM said, how did you decide TLT weighted 100 or 110? Yield doesn't seem to line up with TLT. Yeah, so it's technically speaking, bonds is what's actually the derivative here, right? Bonds is what the market buys, treasury futures, and the yields move in tandem with that. So it's basically 1-to-1. All right. It just might lag a little bit, might skew a little bit, whatever, but at the same time, they're correlated, like close to 1, close to +1, which means that they're going to move in tandem, right? So that's kind of how you want to figure it out. But for the most part, you want to look at the yields. You want to look at the rates. Okay. TLT is going to do whatever it does, but if the rates fall, if the 20-year falls, TLT will go up. Okay, like the rates won't go down 100 basis points and TLT will be flat. That's just not going to happen. Hedge funds will blow up if that happens. So you don't need to worry about that. But at the same time, how did I know that it was $100? Well, I mean, look at the pivot points, right? So look at TLT when it was over here at $100, right? This was back in September 17, 2024. And where was the 20-year in September 17, 2024? Right here. It was about 4% the 20-year. The 10-year was at 3.62%. Okay, so now let's look at recently. Okay, so rates were at 94. I'm sorry, TLT was at 94. Wait, TLT was 94 on April 4th. The 10-year was at 3.8%. But keep in mind, I'm looking at the bond futures for the yields right now. This trades 24 hours, 5 days a week. TLT is only during the market open hours, right? So it's in this chart, you're not going to see it exactly. So TLT could have actually traded lower, but you won't see this because my chart's not showing extended hours. Okay, so that's the reason why. And this question, this comment right here, I don't understand. I'm sorry. Perfect, guys. Like beautiful, Joe. If you don't understand it, don't do it. Very easy. Kris, you're on mute.
100%. If you don't understand it, don't get in it. Exactly. There's one thing I do want to highlight. The 30-year tends to follow oil pretty closely. So when you see major moves in oil prices, so you can see here, the 30-year was nice and flat. Oil prices pretty much just stuck around that $40 to $80 barrel, right? And then you started to see oil prices come down, and you also saw inflation start to come down outside of just the COVID thing, right? The COVID was, of course, right here, right, in this short period of time. But look at oil prices. Oil prices started to come down. 30-year came down. Oil price started to rise. 30-year started to rise. But what you saw is now you're starting to see oil prices coming down, and you already see news coming out of OPEC that the oil prices are likely to keep coming down because they're increasing production. So in my opinion, when you look at oil has a strange relationship with the 30-year where they kind of correlate in price movements, because what happens is, I don't know why, long-term inflation rates tend to follow follow oil. It's weird, but it happens. So at least on a short-term basis. So right now, this disconnect that we're seeing between 30-year and WTI is actually kind of positive. I think some of it has to do, of course, with like some of the credit that usually goes into the oil patch and how that could impact like borrowing. And usually if people start defaulting, then that kind of means that unemployment goes up, the Fed starts cutting, and boom, it's just like they follow each other. So one of the things that's nice to see is this 30-year to 30-year bonds, and it follows nicely. So yeah. So I think right now there is a good chance that we're going to start to see disinflation, of course. And once that happens, TLT will be going higher. Now, there's just one thing. If we don't see it happen, if we see inflation kind of just stay sanguine where it is, the Fed doesn't cut, there's a very real possibility this thing doesn't work out. Okay. And it goes to zero. That's where it's at this point, it's just insurance. So this is insurance against a massive move down. And, you'll underperform a little bit. My expectation is at worst, we'll be able to break even from the theta decay on the $100 calls. At worst, we lose the entire position. But like I said, that's the worst case. If we get to about October, and at the same time, you start to see TLT start, getting close to that $95 amount, what we can do is, once again, downshift by buying back the $100 calls and selling the $96. And what that'll do is basically give you huge amount of capital that you put into this position in the beginning, and basically pull most of your cash out. And now the next 90 days that are around, you'll basically, it'll be like a risk-free bet at that point. So
there's a deadline. Okay. Let me take this part because I kind of want to talk about the tariffs a little bit in this whole trade war crap. And it is trade war crap. Like, this is just crap right now. Like, I don't want to care about a stupid trade war right now. This is not what I signed up for 4 years. Like, I thought I was going to focus on micro, and it's the complete opposite. Trade war speculation. Okay. So we're at 32 minutes. So here are my thoughts. Okay. You have the 90-day delay with every country but China. And really, the countries that the market actually cares about is China, and they care about UK. The EU, right? The other countries, fine, right? Like, it's you already saw UK today. Like, it's not that big of a deal, and Trump has all these announcements he wants to make. He said he's talking the market up, right? But the difference, the thing is that he already delayed every other country but China by 90 days. And he did that on April 11. So what's 3 months or 90 days after April 11? That's May, June, July, right? So July 11, if he's going to delay again, I think that the market is just going to go to all-time highs. And the reason why is because if he delays it again, the market's going to be like, well, he's just going to keep delaying it. Okay. Like, he's just going to keep on postponing it. Like, he's going to cave. I think the market is betting on him caving or coming up with some sort of deal or whatever, because the market expects him to be pressured at a certain point to do it, which they already seen him act under pressure by pivoting. Right. So I think the market's forward looking enough to realize this is going to be a nothing burger. Yes, there's going to be the 10% blanket tariffs, but at the end of the day, this is all just going to go away, and it's not going to be as bad as we thought it was going to be a month ago. I think that's where the market's looking at right now. What the market doesn't expect is any type of material slowdown or anything breaking. So I think that's the thing. That's like a black swan, basically. But technically speaking, when you think about what we've come through, we already had a deal with UK. They're talking about having deals with other countries and stuff. They're meeting with China and Switzerland on Friday and this weekend. On top of that, there was already talk that's saying that, hey, we might reduce the tariff from 145% for China down. There's positive talks happening, and the market loves it. They're eating it up. And whenever there's bad news, the bad news doesn't bring down the market that much. Like, these are things that you kind of look out for, is that when the market doesn't really react that heavily to bad news, or doesn't follow through with it, or the dip gets bought up, and then good news, the market goes up, it's very likely that the market's already moving on past this because you're creating more certainty into the environment. So at this point, this kind of gives you an idea of what will continue happening as more things develop with the tariff war. So now when we think of it in terms of the bond market, I think the bond market's kind of telling a different story. The good part is that on my chart that I have here, what happened for a long period of time, let me get my commodities chart. Look at gold, right? Gold basically hit resistance here around 3,500. Gold was like the ultimate outlier, basically saying like, hey, we're going to have trouble and I'm stiffing this out. So I'm going to take my gigantic market cap and I'm going to expand it. And all these people are throwing money at gold, which is China, whatever, central banks. Like we don't actually know what the hell is what's bidding gold up. But what we saw here was that the safety trade is slowing down. Okay. And it started slowing down when we started having the deals and the talks with China come up. So that's good news, in my opinion, in terms of adding more fear in the market. But when you saw Liberation Day, gold shot up like this, and that's when the market was crumbling, right? So that's something to keep a look at on gold. When gold pulls back like this, that gives headway like, okay, maybe we're going to be in a good place. If I overlay this chart with SP 500, I do a new price scale, okay? When gold got to about here, the market's like, hold on a second, why is gold going up? And then the market started falling and gold kept going up. And then at a certain point, the market just, this right here is when the S&P 500 started its major recovery. And that was when gold kind of stalled a little bit. So a good indicator for me is seeing where gold's at. Another thing that was actually very interesting is that this whole time, crypto's just been going up, but crypto's like, I don't care. I'm just going to keep going up. Crypto's just been going up this whole time, making all-time highs. Crypto is a very good indicator for risk-on behavior, okay? If crypto is just a few percentage points from its all-time high, how can we have a massive bear market and the most risk-on volatile asset in the entire world, crypto, is about to make a new all-time high? That makes no sense to me. Like something like that, it just makes no sense to me why we would make a lower low if crypto's making an all-time high, unless like maybe crypto is the safe haven and I just don't know about it. In my opinion, this is not a safe haven. Like I don't know how crypto is going to save anyone on this planet, because at the end of the day, the most rich people and the most central and the biggest governments in the entire world have the most amount of crypto. How is this a safe haven? Like it doesn't make any sense. So anyways, those are my thoughts as far as where the trade war goes and where the macro goes. So do we want to talk some macro here now?
Yeah, we can do that. Yeah, one last thing just to point out. I don't know if anyone here knows what the Taylor rule is, but basically the Taylor rule is a way to project out what the neutral rate of the Fed should be. So if you look at this right here, you can see that the Taylor rule was triggered way before, when the Fed should have been basically raising rates. They were a little late to the party, and then they started raising rates. By that time, we were already kind of a little bit behind, and then they kind of paused, right? And the entire time, the Taylor rule started to come down. So right now, the Taylor rule, according to Q2 of 2025, is still moving further and further down. So I think eventually the Fed will have to move, especially this year. And when that happens, we'll get to a nice move down. Also, another thing is to look at is some of the changes around rent. Look at owner's equivalent rent as a benchmark. It's gone from about 8 to almost like 4.38. And then if you look at the real data that's actually coming out, like for new like, you know, people that are renewing their leases, it went from 13 to right now to -2, which means that new leases that are being signed by people is actually less than the year before. So once again, shelter is rolling over much faster than people think. And same thing with like the other data sources. If you look at PCE, look at that, from 8 to 4, and it's literally just trending lower and lower. So, you know, I think we're at a point where rent's going to keep coming down, and Usually rent stays around, gets to about 3% and sticks around this 3%. And we're pretty much right there. The only thing with rent is that this time it's probably going to overshoot because we're actually in a point where we've got more rent that's what is that, vacant rentals. So let me just look it up. Hold on. Vacant rental, Fred. So if you look at the rental vacancy in the United States, look at this. It's already at 7.1, which is higher than what it was in 2019. And it doesn't look like it's going to stop. There's a lot of multifamily construction. All of that stuff, all of those apartments are coming online right now. So if you look at hold on, construction apartments. There you go. So you see this literally in the last, from 2010 to now, in up to about August of 2023, there were almost 1 million apartments being built. Yeah, that's coming down right now, but you can see the amount of construction that was happening, and it's insane because now you've got a ton of vacancies that are coming along. So I think shelter is rolling over, and it's nice to see, And if you look at shelter CPI, it's the same thing. So shelter CPI, which is a really big component of the PCE market. Look at this move down, literally from 8% now to 3.9. And historically, 3.9 is where around the threes is where they hang out. So at the rate that this is coming down, this thing is going to be at 2 and possibly even 1 next year. And if that happens, that means that this services inflation from housing is going to take a massive L, and the Fed is going to have to stimulate just to get back to normal again. So this is the thing to really watch out for. If this trend just keeps going down, which I fully expect it to keep coming down, I think we're going to see massive levels of disinflation next year. So you combine shelter, you combine oil, you combine the increase in jobless rates, and then you combine on top of it less spending by the federal government compared to last year and the year before that. You got a recipe for disinflation, and then you've got job losses from AI, because AI is coming around and people are starting to see that productivity can go up and they don't need as many people. I mean, it's a pretty big thing. And then aggregate demand is going down because the Trump administration has been deporting so many people and the borders have been cut. So aggregate demand is coming down. I mean, you're setting up for lower growth, lower inflation in a very short period of time. So,
yeah. Because they're going to be data dependent. I mean, that's pretty much all I have to say with that. Like, I'm not making any rash moves right now. We're about to get above that 200-day moving average on the SP 500. So I don't know.
I mean, if
we'll
it does, and let's say it holds it for a little bit, we literally have to wait until the Trump administration finalizes all this tariff stuff. But I still think the fact that they kept those 10% tariffs on the UK is not what people were expecting. Honestly, I thought we'd go back to being 0 again, at least with them, right? Because they're the first ones. Remember, that's what Trump said. The first people to come to the table will get the best deal. And if the best deal is 10% tariff, bro, imagine what the next 5 are going to be like.
The 10% is going to stay there no matter what. I don't think that's going anywhere. Like you're saying, it's revenue generator. Even though it's not a lot, it's still something, right? And that's the whole point of it, is that he wants to raise the baseline.
400 billion actually could be generated from that, because right now the U.S. imports goods and services about 4 trillion. Okay, so if you take 10% of that, that ends up being 400 billion. Now, China's probably going to be either 20 to 50%, and everyone else is 10, so it could actually be close to 15, which means that it could be 500 to 600 billion. So I don't know. I mean, the Trump administration saying we're going to get rich from tariffs. I think he really believes it, you know?
Okay,
So
so I don't think that he's trying to get rich from tariffs. I think what he's doing is he's using the tariffs as a way to offset the tax cuts that he's going to be doing for a lot of corporations. So the
yeah.
corporations will have an incentive because I think there's going to be targeted tax cuts when he does for corporations. I don't think it's going to be a blanket tax cut. And I think he's going to use that as a negotiation tool to get corporations to build factories and manufacture stuff in the US to make America great again. So that way the debt to GDP ratio won't decrease because the debt's lowering. It's lowering because the GDP is increasing. I think that is the ultimate plan to all this.
Did
And
you see that he's actually thinking about raising taxes on the above 2.5 million individual?
No,
Dude,
oh,
he already put it in.
No, okay. Even if he does, like, if you make above $2.5 million a year, like, you got a lot of write-offs. Okay, like, did you ever see that chart where it showed the amount of taxes that these high-income people pay per year?
Yeah, well, that too, and
it's like it makes no sense that, like, it just.
But then,
yeah, go ahead.
But then you also have carried interest, right? So they want to close the carried interest loophole. So that's another big amount too. So you've got multiple things that even at the higher end that I think this administration really is trying to get to that, but what's the word, to getting rid of that budget deficit, and it's gonna suck to get there, but people are gonna do it.
Yeah, we'll see.
Yeah.
All right, let's move on to the micro. Let's talk Google. I think this is a very big thing, and I have to say, I think this is more than Google. I think this has to do with search. I've heard multiple earnings calls where they've talked about this, and we've heard Apple's testimony. We've seen the court cases and stuff. I think this is a pretty big deal. I think it has a lot more to do with just the Google stock. I think it has a lot more to do with the business model of focusing on search as far as ad revenue goes. So, of course, Google is a center of attention for that one, but there's also other companies that are probably going to be impacted by this, and that includes Reddit as well. Reddit is definitely going to be impacted by this. Other companies that focus more on ad revenue in terms of their old walled garden, like Meta, Amazon, probably not as much impacted as it because people aren't searching online for anything on Facebook or Instagram. They're not searching online for Amazon goods. They're doing it mostly for web search. And when you think about AI and chatbots and even Gemini, which is very highly useful and isn't monetized yet, in my opinion, when it comes to ads. Of course, it is monetized when it comes to selling to consumers and enterprises. But when it comes to ads, I don't think the amount of money they're going to get for Gemini subscription is going to make up for the ad revenue they've been getting through search. So it definitely is something to think about. What we've seen was that Google has been posting, and they made an announcement this morning, or what was it, yesterday, on their press release, that basically they're seeing growth just fine in terms of search. Apple came out and they said that they saw the first quarterly decline in terms of search, and then they're also going to take on either Perplexity or some other chatbot or whatever, as far as the AI search directly on the iPhone rather than using Google search, whatever search capability there is. Cloudflare, they had their earnings today. Matt Prince even made a comment about it. Let me share the earnings call transcript. Yeah, so it's right here. Someone asked the question. Yeah, this is the one. Someone asked a question regarding search. So Matt Prince, who's the CEO of Cloudflare, and keep in mind, Cloudflare, they run like 25% of all the internet traffic goes through them. And on top of that, about 80 to 90% of all DNS traffic goes through them. So they have a lot of data. And that's pretty important to know, because when you think about control over the world, I think data is like the biggest power in the entire world. So what he was saying is that, and so it might be we don't see that directly. Some other people, we think those bits are obviously way more valuable. Okay, here we go. And that is fine. If you look over time, the internet itself is shifting from what has been a very much search-driven internet to what is increasingly an AI-driven internet. So if you look at traffic from Google 10 years ago, for 2 pages, Google crawled, they sent you 1 visitor. 6 months ago, that was up to 6 to 1. The call rate hasn't changed, but what's changed is now 75% of the queries to Google Google answers on Google without sending you back to the original source. But even in those last 6 months, the rate has increased further from where it's now up to 15 crawls for every one visitor. And if you look at OpenAI, which is 251, Anthropic, which is 6,001, they're putting a lot of pressure on media companies that are there, that are making money through either subscriptions or ads in their pages. So what he's basically saying is that when if you use Google search, people see the answer from Gemini and they're just like, this is good enough, right? They're not going in there and clicking on a website like what we used to do in the past, or what I used to do in the past. I used to click on like 5 or 6 websites till I found the answer that I wanted. And every time I click on that website, Google was able to search that, give up that ad, and then be able to make money off it, and then get paid by the people who put the website out there, whatever it is. You know, I don't know the exact details and how that works, but that is how Google made money. Every time you went and searched, you clicked on a result, Google makes money from that. They make a cut from that. What Matt Prince is saying is that these sites are being hit more times than they did before, but not by people, but by web crawling through AI, right? So AI is scraping all of these websites and it's storing it in a database. And that database is what's being used as a retrieval for the chatbots when you search something, right? So that's what you think about LLMs, large language models, is that it's basically a gigantic database of information from all over the internet. And when you use ChatGPT, you type in like, hey, how is my cat sick because they have these symptoms? It's searching its own database of data it already crawled around the internet and looking in there for answering your question. And if it doesn't have that answer, it's going to go in the internet. It's going to reach out. That is where these large obscene numbers come from. And Google does not get monetized off of that necessarily, at least not right now. Okay, they monetize when you go in and you click on a website. But when you have these chatbots go out there, when you have these LLMs go out there as they're training, going through all these websites, right? That doesn't exactly generate revenue for a lot of these companies. And that includes Reddit as well. Because someone asked about Reddit, what I thought about Reddit as well. Like this is impactful toward Reddit as well. So even Reddit, during their conference call, the company was up 20%. They had phenomenal numbers on their quarter, right? So they, let me bring up the shareholder letter. All right, here we go. So this is for Reddit. And I have a position in this company. Okay, so 61% growth year over year, right? Really good numbers. Unique average revenue per unique users, or ARPU, 23%, $3.62, 90% gross margins, operating expenses, and so on. Operating margin is 7%, but it's increasing. It's getting better. Just the EBITDA is increasing, and so on. Like these are really good numbers for this company, and this is the reason why I own them. But what they said during their earnings call made the stock go from 20% up to pretty much flat, and the next day they were down, right? Why did that happen? Well, here's your answer. Okay. So an analyst asked a question about search, right? So the CEO basically said, all right, thanks, Jen. Thanks, Ron, for the question. Users in Google. So look, we're happy with the start of the year. In Q1, we had 18 million dailies, 400 million weeklies. So that's 31% year over year growth in terms of the amount of people that use their platform. And we believe we're in good shape over the medium and long term. Ultimately, we drive growth when we make improvements to the product, which is our focus. So things like onboarding, search, machine translation, they all drive growth over the long term. Now, look, remember, we're an open platform. We want people to find Reddit's content in search. Being open drives awareness and visibility. It also creates variability. We do expect some bumps along the way from Google because we've already seen a few this year. This is expected in any year, but given that search ecosystem is under heavy construction, the near term could be more bumpy than usual. To give you an early read in Q2 through the month of April, we're seeing total DAUs, or daily active users, growing in the high teens range year over year, but short-term bumps don't affect our long-term strategy. We're in control, So they're basically trying to say that the long-term, they're going to be just fine, right? Reddit's going to figure out a way. These are two different companies. That's not Apple, not Google, that already have said that they're starting to see search not being utilized as much as possible. And that's where Google makes its money off search. Now, I'm not here to try to tell you that Google is like, I'm going to sell my Google position. I'm so bearish in Google. I have a position in Google, right? We got to remember, search is not the entire business. But on top of that, this isn't like these CEOs are coming out here and they're just saying like Google's dead like at the end of the year. What they're saying is that they've seen a little bit of a decrease. But of course, the market takes that and they're just like, oh, Google's going to go downhill from here. So let's just like sell everything, right? That's what we saw yesterday. Google's down 10%. That was $200 billion wiped out of Google in a matter of, what was like an hour, right? Saw a little bit of recovery today, but I think the market overreacted because it reacted off of headlines and commentary from earnings calls and so on, but it was mostly headlines as far as the testimony goes from Apple, right? So for me, I'm waiting. I want to see what happens, where data leads us. I'm going to be data dependent. Like, I'm sorry, I'm just going to be data dependent. So I'm holding on to my position. I mean, what do you think, Kris? What are your thoughts about this?
Yeah, I mean, with the amount of share buybacks they're doing, plus all the tertiary businesses that they have, I don't think they have really anything to worry about. Not to mention, there are things that are going to monetize at a much higher level than asking just general queries, right? So if you ask like, hey, let me get a flight between Atlanta and New York, Google Flights is going to show you all of that, and they're going to route you and everything else to the correct thing. Now, Google is going to make a ton of money from an ad like that. But if you ask Google for something like what's 2 + 2, that's not really a monetizable query anyway. So there's not a lot of money to be made in that. So I think Google is still going to retain majority of its revenue from it and its actual business. The bigger challenge is just what kind of valuation do you give this business with the overhang of the lawsuits that are pending against it? That's the only thing that we have to really keep in check. And I think once that's resolved, then Google will trade higher. The other thing is, remember, this thing still generates a significant amount of cash flows that they can redeploy back into share buybacks. And the longer it stays undervalued, the more likely it is that future earnings are going to be boosted significantly from the share buyback. So as I was saying earlier to, I think you, Sam, if the stock is at 150 for like the entire year and you're talking about 75 billion that's going towards share buybacks, that's a pretty big forward earnings move for them, So I would say we have to just look at this and say, what is Google doing to keep its core business at least still producing tons of revenue? I haven't seen any slowdown in that. YouTube is still there. And not to mention the amount of daily active users they have on multiple platforms is insane. And they haven't even integrated AI into their other things like workspace. Like if you look at Google's actually taking a lot of market share with Google workspaces. Hold on, Google workspace market share. So that business is growing significantly. So G Suite, there you go, not off spaces. So the amount of paid clients that they're getting, it's getting up there. So they've got a ton of revenue coming in from all sorts of things that are going to be reoccurring, that are just going to keep lending to this business. So do I think that it's going to hit my original target of about 270 by 2027? I don't know. Maybe we need to, dial that back down a little bit, because I think the expectations might have been a little too high. So maybe around 250 is probably a better price target for Google. What do you think about that?
So, well, check this out.
Mm-hmm.
Weighted shares diluted with Google. All right.
Yeah.
It's just going down. This makes their PE go up. It's financial engineering at its great. This is what Apple does. Apple approved a $100 billion buyback. And this is let me show you this one right here. And this is the amount of buybacks Google's been doing last 12 months. They're at like $62 billion right now, buying back shares. On top of that, they're offering a dividend as well. Not much, but they're offering dividend. Why? How are they able to do this? I'll show you how they're able to do this. cash from operations. This thing just keeps going up, man.
Yeah.
Just going up, just going up. The reason why I'm not using free cash flow is because they got a lot of capex. They're doing a lot of buybacks. So it's going to skew the numbers up. So operating cash flow.
And the capex is going to die down next year. You know, that high level of capex, in my opinion, was to get this investment into AI that they needed to make to basically deal with demand. But I think, you know, as next year comes on, they're going to be dialing back their capex, and that capex is just going to go, especially with the value of the company being where it is going to go into share buybacks. I wouldn't be surprised if we get, like, for 2026, 100 billion in share buybacks.
Yeah, I mean, Apple just did $110 billion in buybacks. Google, they had $75 billion approved. I'm trying to look for that poly market bet where which AI is LLM is like gonna overtake, or is like the most popular one, and like Gemini was number one. Like, it's just like, how do you like, come on, man. Do you think Google is gonna sit by a side and just watch them get like slaughtered by search getting dominated? They're gonna figure out a way. They're gonna figure out a way. We haven't even talked about monetization of chatbots yet. We haven't even talked about that yet. That hasn't happened. It's going to happen. It's going to happen.
Look at this. Google's already got 350 million monthly users. That's insane. Freaking insane. I know.
Yeah.
And they got 35 million daily active users.
It's very hard to believe that they're going to go anywhere. But, you know, like you mentioned before, the target for Google is probably the most important. A lot of people have options on it. If you have shares, then there's opportunity cost as well. That's where my factor comes in. Opportunity cost. Is there probably a better place to put your money? There might be, right? But I think it's like also kind of hedge for the market. You know, if we kind of go down, then is Google going to go down like that much? Probably not. It's mega cap. They're buying back stocks and everything over time. Like, you're probably going to outperform the entire market by owning Google as well. So, you know, like, it's like you don't want to put your stuff in like high risk stuff. Google, it's not high risk in my opinion. I think the risk reward to the upside is pretty good. But is it when you think about options, you consider the time factor in there. And, you know, it's just like, that's something you consider. And if I had the spread still, I would probably wait for a big rally. And then, like you said, I would downshift and then lock in those gains. And that really is the same thing that I would do for even TLT and really any options position that I have. And I posted on there, I have the Robinhood, or I have the Hood 2027 debit spreads, the $700 ones, and they're already up 25%. And I have a lot of time. I have a lot of time to wait. And when it does get to a certain level, I haven't decided yet, but I will probably downshift those as well, and then just sit on my shares and just let it ride, right? So that's the name of the game. For me, the name of the game is mostly being shares and just hold it over time and maybe build up some income, some covered calls, you know, and just see what happens. So that is the name of the game with the spreads. Manage risk.
I think 2025 is definitely going to be a transition year, but 2026 is probably going to be like the year that the Trump administration puts heavy emphasis on stimulus. Because the thing is, like, you know, he measures his success based on the barometer, which is the stock market. That's his thing, right? Like, even today, he was telling everyone, you better buy stocks. I mean, just imagine that the president of the United States telling you, like, hey, listen, you better buy some stocks. That's kind of crazy. I know some people are like thinking it's a top. He's saying to buy stock. Well, if you guys remember, he said now is a good time to buy stocks, and the market had its monstrous 10% rally. Like, I'm not saying we're gonna hit 10% tomorrow, but like, I think he's kind of telling us something. The funny thing is, like, the day before yesterday, I think he was like, this is Biden's market, and next time it's also Biden. Like, next quarter is also Biden's market. But then he said, if it's good, I did it. If it's bad, it's Biden that did it. I was like, come on, guy. It's a
great joke. It's a great joke, because whenever someone says something like goes down, whatever, and it's like, that's a Biden stock, or like that's a Trump stock, whatever. It's like, oh, today Transmedics is definitely a Trump stock. And hey, guys, kudos to the Transmedics bag holders. That was probably, I have to admit, I got out probably at a decent loss on that one, and I'm fine with it because I found another opportunity that did well. And I mean, honestly, that guy Rex, like he's set. Like he's really set. Like that earnings report was phenomenal, and it was the most projected things with the tracking the flights. Like the people on FinTwit, like they have some crazy data out there they track with the spreadsheets and everything. And I mean, obviously in hindsight, it was the most obvious play, but at the same time, it was like it just was not a surprise to see them provide the guidance and everything that they had last quarter. So kudos, guys, you guys deserve it. There was a few other stuff that I wanted to go over as well. So I touched on TMDX, and then Mercado Libre. Their earnings were insane. They had 37% growth in terms of revenue year over year. GMV, or gross merchandise value, which is basically the amount of money that's being spent in their entire ecosystem, grew 70% year over year. And the reason why that's an important metric is because that just shows how many people are using their platform. And just the fact that it's growing is pretty important. And then the fact that revenue is growing on top of that just means that they're able to increase their take rate on it. And I mean, the company is just totally set up for success. They got Mercado Pago, and they also have Mercado Libre. Mercado Libre is the e-commerce platform. Mercado Pago is their fintech platform that originally started and was supposed to be just for their e-commerce platform, but they decided to expand it to consumers, offer credit cards and loans or whatever it is. And they also got the banking license approved for Argentina as well. So this company is not stopping. They are playing the Amazon playbook, customer obsessed and so on. Like they're just not, should I sell? Oh, I can't tell you what to do. I'm not in TMDX, so I don't know. And I have a very small VG position. It's not big at all. So I don't even, like, that's in my HSA account. I'm not even looking at it. So I can't tell you what to do with that. Wow. You got into the bottom, dude. 45%. You got into like the 60s. Wow. I mean, if it's working, the earnings report was amazing.
Don't do anything. Just leave it.
There's a heavy short interest.
Yeah.
Why would you sell? Like, I mean, I'm not saying don't sell. I'm not saying to sell. I'm just saying, like, why would you sell what's working? Usually the market has a way of buying into strength, right? That's like saying that, oh, hey, NVIDIA went up like 100% from $100 to $200. Should I sell now? Okay, well, if you sold, then you missed out an additional 800% gains, right? It's working, so just leave it alone, right? I don't know what your position is, but if you have shares, then just let it ride, man. That is a $5 billion company that is growing immensely, basically has no competitors in the entire world, and their short interest is insane. So I think you'll be pretty happy holding that for long term, in my opinion, but it's up to you what you want to do with that one. So yeah, anyways, Mercado Libre, great company. I mean, a bit overvalued in my opinion. I'm not sure if I'm going to trim or not. I already trimmed 10% around the 2200 level. I'm up 150% on it. So I don't know. I think I'm just going to hold on to just let it ride. Like nothing's going to happen to it. It's tariff resilient, or it's not really impacted by tariffs and so on. All of their customers are in Latin America. So they're not really impacted much by it. They don't really have that much of a competitor. Like C is a little bit of a competitor on, but Amazon's not trying to eat into their competition. So, you know, I'm letting that one ride. Nubank is reporting earnings soon. I think it's next week. That one is up about 25% year to date, and it's a little bit skewed.
That one should do well, considering the FX. And at the same time,
oh yeah,
if you look at the Brazilian central bank, dude, rates are huge right now.
Yeah, they're at a 14.25 right now, and they're probably going to increase it to 14.75 or 15.25. And if you looked at the data, inflation is not as bad as it seems, but also the new central bank chair or director, whatever it's called, he is basically like a pro private person. He's like a Scott Bessent, okay? But he's the head of the central bank, and he's Luna's left hand like favorite guy, right? So
Yeah.
it's basically like if Trump was a big fan of Powell, that is what that would be. Like I don't see how that is not going to end up anything other than good. Like I think that, and Brazil is I think it's like about 80% of new banks revenue. So good news there. Emerging markets, Mexico, Colombia. I think that's a great company. I still think Nubank's a great opportunity. In terms of spreads, I don't know. It's up to you. I think I don't. Yeah, I don't think I
I
have
have
any.
spreads. I have spreads on
Yeah,
them. $15 and $20 strike for
yeah.
2027. So
I think I might have gotten rid of the spreads, and I just have a massive
bunch
share
of shares.
position. Yeah,
Yeah.
but I'm fine with that, man. Like I still think it's a great opportunity right now. Can't really speak for the spreads. Probably a good opportunity for the spreads too, but I'm not going to advise anything like that. But I have no problem like holding on to this company, so I'm just going to go ahead and keep holding on to it. Same thing with Grab, like the go-to merger, that's going to happen. I mean, there's so much movement happening. They've had like 3 people resign or gonna resign from the board of GoTo, which is a company they're supposed to be getting acquired by Grab. Peter Oye, who's the CFO of Grab, he is not commenting on anything of a merger, but he's also not denying it either, which is very odd. Grab have a lot of cash, and they hired like they. I don't remember off the top of my head, but it's like every single piece of news that I read is like they're gonna do the merger. They're gonna do the merger. If they do this merger, this is basically like eating up the entire market in Indonesia. Like they have basically no competition when it comes to mobility and delivery in Indonesia. I don't think they're going to be acquiring the financial arm for GoTo, but that's fine because that's not the biggest competition there. The biggest competition is delivery and mobility. They will have virtually no competition there. Grab is probably the easiest holding I have in my portfolio that I just know will do really well. It's not a spectacular like rock star CEO talking crap about people, like Alex Karp or Peter Beck and so on. Like it's not that type of stock. It's a slow winner. Okay. And I personally don't think that if you want a double in the next year, I don't think this is the right stock for you because of the fact that you're expecting similar parabolic moves you've seen in other companies. I don't think this is the right company for you, but I think it's a great investment. I think if you do the due diligence, time and research, I think you should be able to build that conviction to buy it. I think
You
that's
think
it.
TTD reverts back to the mean?
Yes, I think it's gonna. I mean, look at it already. It's already up 20%. Adtech is not going away. If you think about a recession, which is what the market was thinking was going to happen very quickly, ad spend and marketing is the first to go in companies. And the market freaked out and they sold all of the Adtech down. They sold App11 down, which had a phenomenal earnings report. It's actually pretty funny because those short reports that came out for App11, it was like basically saying like we don't believe the numbers that you have, and like they posted numbers that I don't know how they're doing it, but they're just doing it, right? But TTD basically had the scare that like, hey, their growth is slowing down a lot to low teens, and they were losing profitability and so on. Like their client growth slowing down. And then they came back this quarter and it was it was like the usual TTD on what they do. They always provide great guidance, great quarters and stuff. And on the back of that too, the market expected such bad guidance from them. The company was down 68%, or the stock was down 68% from peak to trough, right? It was in the 40s in April. It hasn't been in the 40s since 2022. it was the biggest overreaction I've ever seen of any stock in my entire life. And this is a huge momentum stock and the leader in demand side platform when it comes to advertising. It's a proprietary platform they built, and the retention is so high in the platform that they're not really going to lose clients. I think the fear was that TTD is going to get its competition eaten up by other competitors, including AppLovin. And AppLovin had their earnings call yesterday, and they basically said they're not, excuse me, Adam Ferrugi, CEO of AppLovin, basically said like, hey, we're going to focus on doing what we're doing right now. We're not trying to get too much into web advertising. So we're going to keep doing what we do. We have a lot of customers waiting around the block. We're going to keep doing what we're doing. And when I read that, I was like, hold on a second. So you're not going to compete with TTD then. And then you saw the earnings report today. TTD is up almost 20% overnight. So great news to see. I wish I trimmed my position when it was in the hundreds, but I did not. So I think I'm about break even on my position now after hours, which is fine. You know, it is what it is, but I'm going to let that thing ride. But I don't think advertising is going anywhere. In fact, I think Adtech is probably going to lead the market up, in my opinion. You saw those numbers for Google, you saw them for Meta and Amazon, and then you saw it with these other ad tech companies. And dude, like, I think the market fully overreacted with Adtech. AppLovin went from 175, now it's at 350. All right. And then Reddit went all the way down to $80. Now it's, yeah, that got hit a little bit, but I mean, Reddit was like $200, which is insane. And it's right back to where I bought in. But I think there's pretty good opportunity with that, even though it's a little bit of scare. I think Reddit's going to figure it out. They got very high gross margins, so they have optionality. And yeah, I mean, when I think of these ad tech companies, I think they're going to do just fine. Even Magnite had ridiculously good earnings. Small cap company. One of my buddies has a large position in that one, and they did phenomenally. Pubmatic also had earnings today as well, and they did phenomenal as well. And like, it's just like these ad tech companies are going to do just fine, right? So when you see ad tech companies do really well, that means that these other companies that are buying ad space or selling ad space, they got money to blow, right? So they have money to blow. That means that they see very green skies ahead. They're willing to spend a little bit extra on advertising, and they're not playing the cut. So I think that's a very foretelling sign in terms of what the future is going to hold. But at the same time, you know, if there's a slowdown, things can change. So yeah.
Good times, brother. Yeah, I'm trying to figure out right now if there's any other like major opportunities long term. I think I want to look more into ASTS. I think that one could be theoretically it could be American Tower Part 2. So, you know, we should keep our eye on that and do more research and see when the first revenues start coming in. I think they actually started getting revenue.
Yeah, they've been getting revenue, but it hasn't been like from subscribers and stuff. But that's actually supposed to start. They're supposed to start getting revenue at the end of the year. Once they start turning on services. But they are by 2026 going to have their full array of satellites in low Earth orbit, which means that they can start providing services to all their customers. AT&T, Verizon, what's the name of that company that's in Europe? Vodafone.
Yeah.
And they're going to start making money. And they even got an investment from
Google.
Google.
Additional money from Google, yeah.
Yeah, they got additional money from Google. I don't know. It's just, I think it's green skies. I think it's very early in the game. I think it's still a great opportunity. And the same thing, RKLB too. RKLB, basically Peter Beck. I don't, did you guys talk about it in Cash Flow Chronicles?
Not really. I mean, we spoke a little bit about Rocket Lab, but I think ASTS has a better position because the way that they're going to monetize is actually kind of unique, and they're going to be basically picking off pennies from the MNO. So they don't have to do any marketing. They don't have to do anything. Just literally, it's the same business model as American Tower, where they provide the hardware and the services. The MNOs provide the spectrum, and basically that's it. And now your phone has capabilities to reach into the satellite, into space, you know. And then there's parts of the country where you don't need to put up cell phone towers anymore. It's kind of interesting, you know. So I think that's something to just keep in mind. And like I said, even if you want to know something funny, if you want to know the quality of investors that they have, you've literally got AT&T and Verizon, which are the two largest things. You've got Google, which is also a large telecom provider with their internet and stuff, Rakuten, Vodafone. But here's the kicker. Freaking American Tower is invested in them because they know how important this thing is, you know? And like I said, look at the planet. There's 8 billion people on the planet. It's going to be big. This thing is going to generate a lot of free cash flow. So
this is
I would say, yeah.
This is a very heavy retail following. This kind of gives me the same vibes that RKLB kind of gave me back then. And I think that they're both very different from each other. I mean, RKLB is actually deploying satellites into outer space to low Earth orbit to provide internet connectivity as well. And then there's Starlink and stuff. It's like, obviously there's competition, but they aren't signed up with these major carriers around the entire world. Okay,
their biggest competitor,
very hard to penetrate.
Their biggest competitor is actually going to be SpaceX. Like SpaceX is doing their own thing, but once again, it all comes down to spectrum and relationships with existing partners.
Exactly.
The challenge, and this is where I feel bad for Elon. Elon kind of like screwed the pooch a little bit. So a lot of people are like, hey, we don't want to just have SpaceX be like the hegemon in outer space anymore. We want other companies to kind of be up there and provide services. It's going to be a very interesting dynamic. But I think one of the areas I think could be the next big area for investment is space. I said this about a year ago, and I didn't really take it too seriously, but I'm taking it seriously now because I think space is going to be it's going to be like another frontier. The cost of launching these satellites has gone down significantly. And yeah, it's going to be good. I think it's going to be good.
It's going to be good. The United States of space, man. I think that's Red Rocks. No, but for sure, man. I think it's very early in the game when it comes to that stuff. And I think it's gotten to the point where I think the market's starting to realize it. And I don't want to sound like I'm trying to pump up anything, but this RKLB and ASTS positions that I have, they're literally in set it and forget it portfolio. I'm not even looking at them in my main account that I look at. So whenever I put positions in there, I just set it and forget it. And honestly, even NBIS is also another one as well, like moonshot plays. And Nebius was an interesting one because Bezos actually invested in one of Nebius's subsidiaries, Toluca, which is basically it's like a managed service providers, but specifically for AI workloads. And on top of that, I think it's a CTO from Shopify also invested as well in the round. I don't know, when you see big names like that throw some money at a company like this, it kind of means something. Kind of says a lot. So that's also a very interesting name that I've talked about ad nauseum. Guys, definitely go check those out. Of course, major retail following companies. So, you can really just get this information basically for free on Twitter. So I don't want to, really talk too much about it. Basically anything, most of the stuff that I know is already out there. So, but yeah, guys, I think that's about it. Covered basically everything that only one person asked to cover, which is Reddit. So I went over that and then looked through the chat. Oh, Peloton? I don't know. I got rid of those naked 2027 calls a long time ago. It's a garbage balance sheet. I don't know. It was a gambling play, but everyone would risk off for a little bit, so I went ahead and risk off with that one. I'm not. I have too many positions on my portfolio. I need to get rid of some stuff. I really need to. But yeah. Maybe I'll buy
Yeah.
more VG. Maybe I'll buy VG. I think that's something I should just like start buying up.
Long term, man. Long term. Here's a question. Are you looking at any other new things that like retail's kind of getting a little bit, I don't know, like interested in?
Oh,
Because I
Palantir.
think, oh, Jesus Christ. I think that's it for the stream, brother. Okay.
Yeah, I mean, I just they overtook Salesforce in terms of market cap.
That's because this is like a
I just
repeat of
yeah.
this is a repeat of 2001 Tesla when Tesla got to $400 a share. You
I
know,
don't
it's not.
know.
Yeah, it is, dude.
I think that this is probably something that'll always be up there because I think defense spending is just going to keep increasing, and I think it's going to be targeted specifically toward new age defense stuff that Shy uses all the time. And I'm not drinking the Kool-Aid because I don't own Palantir, so you know it is what it
Yeah.
is. But I think that it'll always be an expensive company. To this degree of valuation, I don't know. But it was just at $70 like a month ago. So if you got in, congratulations, you're already 100% up. Yeah, I mean, it's a trade for me if I ever get in. I don't think I'll ever hold on to this company for a long time because I cannot bring myself to owning this company and these valuations. I can't. Like if I get in, it'll just be a trade. I'll sell puts or something. Like I think I sold put credit spreads on it the other day. So I already took my
On what,
profits from that.
Palantir?
On Palantir, yeah, I sold put credit spreads. It was a pretty good risk reward, and I took profits of like I think 30% gain, and then I still have some put credit spreads that I opened up, which like basically it was like $4.50 put credit spread that basically the most I would lose was 50 cents. Right. So I was like, well, I could either make, and it's pretty much in the money at this point. So I'm like, okay, I'll take it. Right. So that'll be fine. But I don't think I could bring myself to buy this company at these levels.
You know who did really well post IPO? Service Titan. Service Titan's at 116
oh, you know what?
now.
116?
Mm-hmm.
They only went down to $80. That was the lowest they went. I was actually kind of surprised in April they were at $120. And I was like, how are they up so much? But yeah, I don't think I'll ever own that company. And I'm fine with it. There's too much small business. There's too much. There's a lot of risk when you think about that company because they focus on a lot of small business and a lot of small business that revolves around contracting. And if the housing market slows down materially, I don't know how good that stock is going to be positioned. But I don't know. We'll see. I mean, it's not even that expensive anyway. So
yeah. Dude, ServiceNow is just another.
Yo, tell me about it.
$975. Yeah, ServiceNow literally when it IPO'd, what was it? $23. When
That's
it IPO'd.
insane. I wish I got it. But that was Frank
2012
time. Yeah.
Yeah.
No, it didn't IPO in 2012. It IPO in like 2015 or 16.
No,
they had their financials up since 2012, though, I think.
Yeah. I don't know. That shit got all the way up to almost $700.
Oh, no, you're right. You're right. Wow.
And IPO'd very cheap.
Wow. I mean, who would have known, though? Who would have known?
$25 to $600 something. I knew because my company switched to ServiceNow like literally in 2015. I just never bothered like buying.
That's when I used it. That's when I used it. So actually 2016 is when I started using it, and I was like, oh, okay, this is cool. I didn't think about it like us. Yeah, this is a cool product. Okay. Like I didn't really think about it.
Paycom is recovered too.
It's at Paycom's up $40. Yeah.
Yep. Yeah.
That was an opportunity. I know that was a huge value stock that a lot of people got into, including Capital Mindset. They were very big in that one. Kudos to them for getting into that one. I don't know, man. Like there's a lot of good stuff out there actually. Cause you asked me like, which company do I see as a good deal right now? You know, I have to admit, there's some small cap companies that I am interested in just doing a moonshot play on. I don't want to say it because I feel like if I say it, then people might just run with it. Arista Network or ANET, I was
Mhm.
thinking about buying it when it was in the 60s, and the thing's at $87 right now. And I'm not gonna rag on myself for that because like everything went up since then.
Yeah.
But that was one. I have ALAB, Astera Labs, and I actually
Yeah.
added to that position. Still underwater in it, which is cool. I have MRVL. I think MRVL is a good price right now. Hasn't recovered that much, but it's gotten some bad news lately because they pushed back their investor day.
Yeah.
But I think that company is going to be just fine, and I think the market just overreacted to it.
Yeah.
That's something I own, and the price is still very suppressed.
Broadcom.
Broadcom recovered fully.
Mm-hmm. Broadcom is at 207.
Well, I missed that one. Yeah, I 100% missed
146 to 207.
Dude, I don't know how I missed this one. I don't know how I missed this one because I use my whole house runs on Ubiquity. Their software, and the
Routers?
hardware.
The
Yeah,
routers?
it's networking equipment. They also have
Mhm.
security as well, but like they're like locked into consumers and enterprises. But I remember when it was here at $100 and stupid Meet Kevin was all about it. And like that was the reason why I didn't bother doing it, was because it's like this guy's trying to pump this stock, right?
Yeah.
Yo, like, oh goodness, look at this thing. Yeah. No, I know he's right. I'm pretty sure it's not over either. But I think I was thinking about buying in actually when it was around here in April. But again, there was so much opportunity at that time that I just didn't. I ended up buying Robinhood, which is returned much more than that. So not too disappointed about that one. There was actually company. Oh wow, Wingstop is almost at $300 again.
Yeah.
Crazy. Oh, UNH. I would not. Look at this. Look at this chart, dude. Look at this chart. Would you buy this? Like,
No,
I would not. I would not touch this company.
There's definitely some issues with like regulatory that they're gonna have to contend with, which is not good. You know.
Yeah. I would not touch this company. I just look at this chart. This has end phase written all over it. Like, what? Like, why would you? Like, they're not going to go anywhere, but this can go lower. Okay, so if you're going to take a stab at this, then like you better be ready to stomach more losses if it happens. I'm not saying it will go lower. I'm just saying like you need to be comfortable knowing that this falling knife will continue falling. Like you are literally catching a falling knife. Like look at Path, dude. This thing hasn't even recovered.
Yeah.
At all. Hasn't recovered at all. This is a good one. I wish I had a small position in this one, but I ended up selling it too early, but it's all good. What do you think about Starbucks?
They've got China headwinds. That's the challenge with them. I mean, they're in the process of the turnaround, which is good, but dealing with those China headwinds is going to take up more than a few quarters. So it's something
I
to
don't think
watch
it's
out
just
for.
China, dude. I don't think it's
You
just
don't think
China.
so?
I think
Well, it's
this
also
guy.
coffee
I think
prices.
this is its big competitor, man.
What,
Freaking
Dutch
Dutch
Bros?
Bros. Yeah, did you see their earnings? It was
I did.
it was a really
But
good.
the thing with
Yeah.
here's the challenge with Dutch Bros. Dutch Bros is like it's for like the young, trendy people, right? It's like,
But that's the moneymaker.
Yeah, I guess, but I don't see Dutch Bros overtaking Starbucks, but it does provide headwinds. Yeah.
Starbucks is going to get slaughtered because their coffee is just overpriced. But the problem is that they were the ones who initially increased the price of their coffee. And then everyone started doing it. And now coffee is just expensive, period. So people see this and they're just like, well, I could just go somewhere else, right? Like it's no longer has that like luxury that it used to have, right? Like it's lost it. I feel like it's lost it. That and when these Dutch Bros start coming out with all these like cool drinks that they have, like people will just go to Dutch. If there was a Starbucks and a Dutch Bros next to me, I'd just go to Dutch Bros. Like I would not go to Starbucks. Yeah, I would, but there's no Dutch Bros around me, so I won't go to Dutch Bros. But yeah, I mean, I still do my Starbucks, you know.
Yeah.
Dude, Confluent. I went degenerate on Confluent. I went
How's that doing?
degenerate on.
How's
It's
that doing?
doing phenomenal.
Nice.
So on my shares, I'm underwater.
Mm-hmm.
I am
But on your
underwater.
options,
My
you're doing
shares.
well.
Oh, so on my shares, I'm underwater because I bought back in at like $25, I think.
Yeah.
But I got in some 2027 leaps at like 1930. So I'm doing pretty well. Confluent is not going anywhere. I don't know why they sold off this stock this low again. Like look at this. Like look at this. Look at this chart. Even if it's in a range, like this is this is the range, and this company is not going anywhere, man. They have Netflix uses them,
Mm-hmm.
and Netflix will never get rid of them because Netflix
Yeah.
100% relies on them. So Netflix might create their proprietary platform, but Confluent is already expanded and took out the risk of client concentration. So why did it sell off? Well, I mean, it's a non-profitable company. I think they're still burning cash. No, I don't think they're burning cash anymore. But the market hates that stuff. So there'll be one day where people are going to be like wishing they bought Confluent at $20, and I will just be chilling. So I don't have to worry about that one.
You know what? I am gonna be long on the cruise lines for the next 5 years, bro. As they're paying off their dividends, they're growing, dude. They're value plays. They're
Oh
such
wow,
easy value
it pulled back
plays.
from $21. Interesting.
Who?
So why is Norwegian still down here? But I already know the answer, but I guess you could explain to everyone else why Carnival has recovered pretty considerably, but Norwegian is still chilling down here.
The guidance that they gave, so Norwegian's strategy going forward is that they're trying to just make sure that they're getting optimal cash flows. So they're not trying to do a heavy amount of discounting, right? They're like, look, we would rather have like a fewer bookings like way far out because we feel like we can actually demand more returns. So people thought that that's like that means that they're seeing like weakening demand, right? Versus Carnival's like we'll book out a year in advance and we'll carry the float. So they're taking a whole bunch of deposits up front. And so what Carnival is doing is actually kind of smart. So imagine right now you book, like you tell somebody, hey, listen, if you book a ticket a year in advance or a year and a half in advance, we'll give you like 5% off. And what they're doing is they're taking that cash and paying down debt with it. So it's like operating cash, utilizing it. And so what's happening is now that's money that you're not paying any interest on, So with Norwegian, their debt level is not going down nearly as much because they're buying a lot of new ships. So they're coming, like literally, if you look at their earnings, they have a bunch of ships that are coming online in the next next 5 years, and each one is like pretty big. These are big ass ships, so the debt load is not going to go down nearly as fast. Carnival's like, we don't give a shit. We're going to pay down our debt. We generate 4 to 5 billion in free cash flow per year. We're just going to knock it out. And so if you think about it, if you take the earnings like for Carnival, you give it like a 10 multiple on its EBITDA and then subtract out the debt. The thing is, because Carnival is committed to paying down its debt really fast, you're getting a point where the return on value for shareholders for Carnival is a lot more than Norwegian, who's taken, hey, we're going to grow at all cost, but then at the same time, you're keeping your debt levels high. And the thing is right now, since interest rates are remaining high, that means that more of your cash flow is going towards servicing the debt. So Carnival is pursuing the strategy of, we're already big enough to the point where we don't want to get super big. We're happy with where we are. And we're going to focus on paying down our debt and getting to investment grade credit. And if we get to investment grade credit, that means that we can lower the overall debt even further down. So the chances of Carnival getting to that $35, it's a pretty good chance. Norwegian is a much smaller company, but they're generating a ton of cash. And but the cash that they're getting, they're utilizing to reinvest in growth. So one is being conservative, the other one is being growth oriented. So that's the thing. And Carnival is a little bit smart in that they're doing their private island, which it's going to add to their EBITDA and lower the cost of cruising for a lot of their patrons. Because what's going to happen is the ships are going to be able to go directly between the islands, and it's going to be a money maker for them. They're going to do really well cash flow wise. So I think you have to really look at some of these companies like 5 years ahead of time and say, okay, like what is this company going to do? So if you look at like Norwegian, right? Let me just show you guys as an example. This is Norwegian Cruise Lines. Okay, their earnings are projected to be, actually, let me show you on a better one. Let me go to this, stop sharing this one, and let me just share window this right here. Okay, you can see my screen, right?
Yep.
Hello. All right. So if you look at this company, right, one of the things that one of my friends who's been working at a hedge fund, he told me like one of the strategies that they do, especially for long-term investing, is if you look at a company for like next year's PE or the year after that's PE, you're already going to fail. Like it's not worth anything. He said, look 5 years out and say, okay, what is this company's actually going to be worth 5 years from now? So if you look at Norwegian, according to most analysts, they're going to be doing about $4.26 in EPS. It's trading at $17 right now. So you're looking at a 4 PE. This thing usually trades between 11 and 16 PE. Okay. So good years when things are like rocking and rolling, this thing will go to like 16 PE. If it's like a conservative year where, like there's not as much growth, it's going to be closer to like 12, 11. Right. So if you think about this, like 2029, and you just multiply this by, let's say, an average of 13, literally by 2029, it'll be like 4.26 times $13. That's $55 a share. Okay. When it comes to spreads, and I'm going to give a little bit of a proprietary secret to how to do good on spreads. You find companies, you find companies that have a U-shaped recovery. And why do you find a U-shaped recovery? Because if you look at how options and especially spreads work, if you have violent moves higher or violent moves down, what ends up happening is the cost of those contracts is going to be based on that volatility, right? So if you look at how leaps work, they work not based on the actual fundamental value of the business. It actually works on the volatility. So the Black-Scholes model is broken. And what we do is we take advantage of Black-Scholes, so just letting you know, I'm not going to go too much into that because it's a little bit like I have a little bit of a proprietary formula on it. But the key is the options markets use Black-Scholes, but Black-Scholes is absolutely garbage. And I don't know if you've ever seen this before with Buffett, because he actually explains it pretty well. Let me see. Black-Scholes Buffett. Right here. And that's one of the core strategies that I use to manipulate this. Now I do something a little bit separate, but we'll see. Hold on.
You had indicated in the past that you did not think that the volatility-based or Black-Scholes models for options pricing was correct. Would you share with us how you would evaluate those options as you use them in the business or see them in the marketplace? And also, if you would update us on your thoughts on the asbestos tort situation, given recent developments of national settlement trusts, et cetera.
Yeah, Charlie and I have thought about options all our life. I mean, my guess is Charlie was thinking about that in grade school. And, I mean, you have to understand, you don't have to understand Black-Scholes at all, but you have to understand the utility and in a general sense the value of options, and you have to understand the cost of issuing options, which is a very unpopular subject in certain quarters. Any option has value. I mean, I bought a house in 1958 for $31,500. And let's assume the seller of that house had said to me, I'd like an option on it, good in perpetuity, at $200,000. Well, that wouldn't have seemed like it cost me much if I'd given it to him. But an option has value. Any option has value. And that's why some people who are, kind of slick in business matters sometimes get options for very little or for nothing. I'm not talking about stock options. I'm just talking about an option to purchase anything. They get options for far less than really a market value would be. Black-Scholes is an attempt to measure the market value of options, and it cranks in certain variables, but the most important variable that cranks in that might be subject, well, it might be a case where if you had differing views, you could make some money, but it's based upon the past volatility of the asset involved, and past volatilities are not the best judge of value. I mean, if you looked at it.
Okay, so this is the most important point. Did you hear what he said? Sam, are you still there?
Oh yeah, no, I heard what he said.
Yeah. Okay, so just letting everyone know in the chat, that was the key statement that we need to understand when it comes to some of the options that we do. When it comes to volatility, that's how they measure those long-term options, those leaps, right? So imagine right now you have a company for the last year and a half to 2 years, it's been doing this, and it's just been staying pretty much range bound. Okay. Do you know what happens when it stays range bound? There's options mispricing, especially on leaps, because what happens is because that options volatility was so low, the forward curve on those options that you're going to get is actually very, very discounted, and it's very cheap because everyone's thinking, this is just going to stay like this. But then what happens? The fucking stock breaks out. And now those options that you got that were super, super cheap, they become extremely valuable, right? So the example that I'm going to give is, and Amit knows this one. Let me just pull up the chart on Robinhood. Okay. Because I think this is a perfect example. Present screen. Okay. Can you see my screen? Let me just double check. Okay. So if you look at Robinhood, right, and you look at a 5-year chart, look at what happened to Robinhood. It IPO'd, came out at, whatever. And then you see this right here, how it hung out between $7 and $8 for almost 2 years. Look at that. So what happened was Black-Scholes, because the calculations that they used, it wasn't based on the fundamentals of the company. It was literally based on just the volatility that it had experienced within the last year and a half to 2 years. Then Amit came in and said, look, I think Robinhood's a great company. It's starting to generate cash flows, blah, blah, blah. So he was able to buy those options, those leap contracts for super cheap. Okay. Because look at the volatility. It's barely any volatility, right? And then all of a sudden this thing jumps. And when it starts jumping like this, that's when all those leaps that he had, they went parabolic. Okay. So this is the thing we're looking for. We're looking for stocks that have moments like this where they're literally flat for a good portion of time, and then something clicks in their business model and it goes profitable and then just goes parabolic. Because what happens is that's where you'll get huge amounts of alpha, because there's mispricing in the leaps that are out there. So let's finish watching the Buffett thing, and then yeah, and then I gotta go. Okay.
Had a 5-year option on Berkshire stock at various times. Berkshire stocks had a fairly low beta, as they call it. The beta is a measure that people in academia always like to give Greek names to things that are fairly simple, and so that they have sort of a priesthood. It's like priest talking in Latin or something. I mean, it kind of cows the laity, but beta is a measure of past volatility. Berkshire's had a low volatility, but that didn't mean that the option value of it to anybody that really understood the business was lower than a stock with a higher beta. And I think what Charlie said is that last year is that for longer term options in particular, Black-Scholes can give some silly results. I mean, it misprices things, but it's a mechanical system. And any mechanical system in securities markets is going to misprice things from time to time. And we made one, as I mentioned last year, we made one large commitment that basically was had somebody on the other side of it using Black-Scholes and using market prices, took the other side of it, and we made $120 million last year. And we love the idea of other people using mechanistic formulas to price things, because they may be right 99 times out of 100, but we don't have to play those 99 times. We just play the one time when we have a differing view. Charlie, you want to comment on?
Yeah, but Black-Scholes is what I would call a know-nothing value system. If you don't know anything at all about value compared with price, in other words, if price is teaching you all that can be known, then Black-Scholes on a very short-term basis is a pretty good guess, for what a 90-day option may be worth in some stock or another. The minute you get into longer-term options where you don't have the know-nothing factor so extreme, it's crazy to use Black-Scholes. People use it just because they want some kind of a mechanical system. But at Costco, for instance, within a fairly short period, we issued stock options at 30, and we also issued stock options at 60. And Black-Scholes valued the options we issued at 60 as a strike price, way higher than the options we issued at 30. Well, this is insane.
Well, we like a certain amount of insanity.
Yeah, well, it's good.
Yeah, so that's the secret sauce to Kris Patel's picking of certain spreads. So all the people that made a buttload of money on Verizon on your spreads, you can thank actually Warren Buffett and Charlie Munger for that thing. So like I said, I'm trying to figure out ways to find positions that have that kind of move, and you could do really well. Like, look at what happened with you and Grab. Grab stayed at $3 for how long? So you got your option super cheap, right? And then this freaking thing blew up.
So I actually, when I switched to shares, I sold a lot of those options around like 470 when it was a 470.
Yeah.
And then I picked up more options like 410.
Nice.
So these are just naked $5 calls, but I have a lot of shares in the company. But
yeah,
I mean, yeah, no, it was a good play. But
see,
I
the
mean,
thing, what I did, you
go
want to know what my cost basis on my spreads for Grab is right now? It's 20 cents between $5 and $7.50. Okay.
How'd you get it so low?
I was naked. And then when Amit started posting all the stuff on Twitter, remember that $5.50 like giant bump up?
Oh, you sold the options?
The freaking premiums. No, the premiums on the 750s went insane. So guess what I did? Because volatility spiked. Sold them. And now I got most of my money back. It only cost me 20 cents. I have 750 contracts. Spreads.
Did you go naked again?
No, I just kept it.
That would have been crazy if you went naked again when it pulled back. And then you sold it again.
My break even is $5.20, but against that, it's $7.50. So imagine it goes to $7.50 by 2027.
You make 200. You make 230. You basically make what is that? Yeah, you
10x, 10 almost 11x return.
Yeah. I think. See, that's the reason why I own a lot of shares, is because I don't want the store to end when it goes up there. I want to still have the shares. So I actually own a lot of the $5 naked calls. Yeah. And I also have the shares too. So I'm probably going to exercise them later on, if anything. But yeah, I want to hold on to this company for a long time. I don't think they're going anywhere. Did you see the picture with Anthony Tan and Ray Dalio and the head
Yeah,
of
I did.
Wolf
I
Wall?
did.
It's like you don't just get into that situation luckily, right? Just
I will say
there's so
this:
many good things about the company.
that strategy that I use, the multi-leg strategy, where you go into one and then you sell the other one later, it's actually kicking my ass right now when it comes to venture global, because I have naked $10 calls for August, and it sucks because now the volatility has kind of died down.
Yeah,
When the vol went, when I could have sold the $15 ones at a really good premium when it spiked, vol spiked. So my hope is that earnings comes out in May. If vol spikes and the price spikes, I'm going to sell the $15 calls against it, pull most of my cash out. And then this way, the rest of it, I'll just let it ride. So, it'll do its thing, and then I'll have August. But I also started to buy and this is going to shock you, 750 VG calls against 2250. Okay. Do you know what my cost basis is?
Well, what is it?
$2.
Well, hold on a second. What year? Or when's the expiration?
2027.
Oh, that's interesting. I thought they only had until August.
No, the new ones came out. So majority of the ones that are out there, I own.
I might check that out. Then. No, that's the problem with going naked, is because you're not protected from the implied volatility crush. Like, at least if you had spreads, it'll protect you. But because the fact that you're short, the implied volatility as well will protect you. But if you're naked, then you're like totally screwed.
The fact that we got those carnivals were fucking dirt cheap, dude. $2. They spiked all the way up to like 7 something. I mean, we should have took some profits. I'm not gonna lie, but hey, what are you gonna do? Yeah. So Raj, how do you select price? You know what? Maybe next time we'll talk about that.
Next time,
Sam's got to go.
Yeah. I gotta fucking drive to Vegas tomorrow. So it's a 5-hour drive.
Wait, you're going to Vegas again?
Yeah, one of my buddies is flying in from New York. So him and his girlfriend or fiance, I don't know, but nice. He's one of my boys, so I haven't seen him in a long time. But
nice.
I don't know if I'm gonna regret it because I'm still jet lagged.
Craps table, bro. Get on that craps table. That's my poison. Craps.
Dude, you know what's my craps table? Friggin' stock market. Like, I just feel like, well, because if I play craps, I'm only playing a couple $100. But like, if I'm playing with options, I'm not playing a couple $100, right? So it's like, it's not enjoyable anymore. Like, because craps used to be like very enjoyable back then, because it'd be like, you play like $300-400 and like, you'd either make a lot of money or make a little. But then now it's like, I could have my own craps table in the last hour before close. Like, it's just, I'm not doing that, but I'm saying, like, I could put $300 here, or I could buy $300 worth of hood leaps, and then probably have a better opportunity of making money there. Like, it's just, But yeah. All right. That is.
Have a good one, guys. Thank you for joining us at 1 a.m.
This will be available immediately after on YouTube, and I'm going to post the timestamps on there as well.
Raj is greedy as hell, bro. He's already looking at those leaps. He's like, oh, let me look at those spreads, see what they are right now.
Raj is going to be right. He's going to be right with Tesla, and
I hope so.
It's going to be back at $480, and I'm going to be like, oh, okay, Raj is right. So it's so funny because like people are in just such disbelief with Tesla, but I think they're going to be fine. It's just, I've come to terms with me. Like, I will never be an investor in Tesla because it's just a trade for me. Like, it's just a massive momentum trade. But I'm sure Tesla's going to be just fine in 5 or 10 years. And then people will be like, oh, I could have bought it at $200. And say, yeah, you could have, but you'd have to sit through a lot of volatility, a lot of it.
Yep. All right, brother. Have a good one.
All right. Have a good one later.